Number one, you either raise rates to fight inflation, but then the debt servicing costs too much, or you just leave the rates artificially low, but then what happens is the yen will collapse in value and then you have a currency crisis instead. Now, if this was just a Japan problem, we probably wouldn't care that much, but it's not just a Japan problem, and here's why. As Japan's bond yields go higher, they actually become more attractive to Japanese institutional investors. For years, when interest rates were close to zeros, Japanese institutions like banks, insurance companies, and pension funds, they would actually borrow money from the Bank of Japan for a virtually zero interest rate. And this created an opportunity for what's called the yen carry trade. Japanese institutions or other institutions would borrow money from the Bank of Japan for a near virtual zero interest rate. They would convert it to US dollars, and then they would take those US dollars and invest them in US treasuries or things like US stocks. And the idea was pretty simple. If you could borrow money at 0%, but you can earn a yield of 5% in the US markets or in the US treasuries, then why wouldn't you do that? And this arbitrage play works as long as the math remains favorable. However, right now we're seeing the Japanese 10-year bond yield sit at around 2.1 to 2.2%, and the Japanese 30-year yield sits at around 3.33%. However, that reached almost 4% earlier last month. Because of this, the difference you make between borrowing in Japan and then buying US treasuries or US stocks, that shrinks a lot. So here's an example. Let's pretend a Japanese pension fund borrows $1 billion worth of yen at 0.1%, and then they buy US treasuries that are yielding 4.5%. That's a 4.4% spread. That means they're essentially earning $44 million a year in profit just by using this arbitrage play. But now you can't borrow at 0.1% anymore. You have to pay 2.1% for the 10-year and the 3.3% for the 30-year, as well as you have fees, currency conversion costs, and currency hedging costs. The spread between the two shrank quite a bit, and now the free money is essentially gone. And so if you were an institutional investor in Japan, why would you take on this currency risk when you could just invest in your own bonds? And this is what's happening now. This is called the unwind risk. That's when investors who borrowed yen to buy foreign investments, they're now facing higher costs. And so what do? They want to unwind those investments and just invest in Japan instead. In order to reduce risk, you have these Japanese institutions. They are selling off their assets, they're converting their dollars back to yen, and then they're paying down their debts.